Okay, well, hey, everybody, thank you for hopping on and spend some time with us here today. My name is Mitchell Hora, and I'm the founder and CEO here at Continuum Ag. This is a continuation of our webinar series, just bringing in more experts and a lot of our buddies in the ag and carbon and tech space to talk about their initiatives, talk about things they have going on, and highlight opportunities for our network and for all of you. So appreciate you hanging out with us here, and I hope this is going to be informative. As we go throughout the webinar, ask any questions that you want in the chat. Raise your hand if you want to, come off of mute, come in and ask a question. Of course, anytime. There will be special time at the end to ask questions as well. But feel free, to jump in, ask those questions as we go so that you don't forget them. And the more questions, the better. So with Continuum Ag, real quick, we're a software platform providing farmers a digital roadmap for soil health success. We're based in Southeast Iowa. We help farmers focus on building soil health, utilize then their data to go after carbon initiatives and put more dollars back in their pocket. Today, excited to have my buddy Ben join us here. Ben and I have been running a lot of the circles for the last couple of years. I met Ben when he was at Corteva, working on their carbon programs there, but he's a Midwest guy, upper Midwest guys, but I don't know, what do you have to call yourselves? But
I'm not an Iowa Southerner.
Not an Iowa Southerner. You're a Minnesota West, I think, right? Southern Canada,
Eastern North Dakota.
Eastern. But no, yeah. So Ben's from Eastern North Dakota, but living out in Silicon Valley now, trying to culture those folks a little bit. I think, right, Ben, teaching them how the Midwest works here. But Ben's got a really cool company here going now since he broke away from Corteva. It's been more than a year since he broke.
About 15 months.
Okay, a little bit more than a year. Broke away from Corteva, and then he hit me up. I don't know, at least a year ago. I'm like, hey, I got this new company that we're working on called Fractal, and Fractal has since launched and got some things going here now. So we're going to talk a little bit about that, but not necessarily as this isn't a sales pitch for Fractal. My point here is that there might be some interesting financing opportunities for your farm. I know in my farm, we're going to need additional capital to continue to expand. We're a 700-acre operation. I personally own 40 acres that I was able to purchase utilizing a beginning farmer loan. But now I'm not able to utilize programs like beginning farmer loan for the next phases of expansion, should those opportunities present themselves. So having a opportunity like working with a Fractal, I see where I'm a target customer. I truly believe I will actually be a customer at, when the time is right here. So I just wanted to highlight that as an opportunity, I think, for everybody else as well. We're going to talk a little bit about, the farm land transition outlook, and then, of course, tie back into carbon intensity here though, too. But Ben, appreciate you spending the time. I'll go back here. Let you kind of tee things up just a little bit more though, too. And, we'll turn it over.
Yeah, thanks, Mitchell. And it's not quite as good as seeing you with a bush light in our hands, but
Yeah.
a close second.
There we go.
Yeah, appreciate everyone taking the time. I mean, I think the biggest thing when Mitchell and I were kind of talking about this, just like really started with the farmer need. And I think we hear it more and more, both with our customers and just being out in the field, about just the massive transition that everybody's talked about for 10, 15 years that we're just really starting to see in really material ways. So what do I mean when I say that? I mean, everyone talks about the average age of a farmer, also the average age of a landowner. And most analysis thinks that half of land will turn over in the next 10 to 20 years. And if you really think about that, especially with the capital intensity of farming increasing, equipment costs, input costs, not to mention land costs, and when a bank will generally only go 40 to 60% of a piece of ground in terms of like what you can finance, it just comes to simple math. Like, we need capital to keep farmers on the ground. And really, we started the company with what probably for many of us is a very common sense assumption, which is who is the best steward of a given asset. And we believe that it is a self-interested farmer, not because just because we all grew up in kind of rural communities that we want to see thrive, because it's just selfishly a better bet for an investor and kind of common sense. So I guess I'd be curious, Mitchell, just like from in your area, what are you guys seeing in terms of investor pressure, just that need, and
Yeah.
how real is that, or are we just, have I been out in California too long?
No. It's a huge, huge deal. Now in Iowa, it's a little bit different. Okay. So as farmers in Iowa, there are some protections against foreign investment and outside of Iowa investment in farmland. I believe it's that they can only own X amount. I forget if it's X amount of acres or X amount of value, but there's some type of stipulation. Now, there's of course some gray area, and there was ways to get around it, and there is absolutely um, institutional land ownership here in Iowa, and there's investors coming in and accessing land. However, a lot of it is hindered because of some of the regulatory burden there for outside land ownership. However, in a lot of the states represented by the folks on this webinar, I'm sure a lot of you are facing outside investment coming into your neighborhood looking at buying land. We've seen a lot of massive deals there happen with investors. Obviously, the big one that people talk about is Bill Gates buying a bunch of farmland. He's definitely not the only one. There's a lot of that happening, but it's going to continue to happen is the thing. And I think that's my take on it is we've got some protection here as landowners in the state of Iowa to fend off foreign land investment, but that institutional land ownership is a trend that's going to continue. And if we're going to compete against that as family farms, we're going to have some options because those investors have very deep pockets. But that lack of connection with the land, I do think, is not in every case, but in a lot of cases, it can be missing.
Yeah, and I think where we also see it as a lot of challenges just in transition planning, and not just for farmers. That itself is its own whole can of worms and a very difficult process. But when you think about landlords, and oftentimes you'll see land go into a trust, and only one member, let's say 1 out of 4 kids, doesn't want to go. And if you just think about the pain that folks face, a lot of that land's coming up for sale. And so maybe the last 10, 15 years, folks who expanded a lot through increasing their amount of rented acres, they're starting to see real risk. So they have all this infrastructure, let's say just sport, let's use nice round numbers, 5,000 acres. And they might have a landlord who has 700 of those acres. And sadly, that landlord passes away. And that next generation isn't interested in owning farmland because they live in Chicago or wherever. All of a sudden now you could see a big chunk of your acreage and your operation go away to somebody else. That's one big thing that scares the heck out of us. Another thing that we're seeing in Iowa especially is the rise of kind of farm management controlled custom farming, where that farmer isn't even making their own agronomic decisions. It's a farm manager telling, hey, this is what you're going to plant, this is the variety, this is your your fertilizer schedule, all that. That is crazy to me in terms of, it just doesn't pencil in my mind, but maybe I'm just too simple. And then the last thing is just rental auctions, where farmer margins again being compressed in different areas, and so it just seems to be this onslaught of different things that are going against the farmer as that steward of the asset, which we just think is a little bit nonsensical. Again, from kind of selfish perspective as investors.
Yeah. And so everyone knows too, on my angle with looking at capital here is that I bought some farmland in 2017, and the value of that land is probably just about doubled since I bought it in 2017. Looking at other, other comparable land and stuff in there, it's a 40-acre chunk. 39 of the 40 acres tillable. I mean, it's a pretty nice piece. And I bought that land putting 5% down, and then was able to finance about half of the remaining loan through the Beginning Farmer Program and half with my local bank. And as I was talking with Ben about trying to understand what is this concept of being able to utilize that built up equity, I've got to relate it back to my farm. And I think that's, what we can get into here now. But for me, I've got a lot of my equity tied up, in a lot of my equity tied up in the in Continuum and in the company and in other things. Like I'm not able to tap into that cash if we need to go and buy another piece of farmland, but utilizing built up equity in that asset that I already purchased provides some some opportunity there. And that's maybe where we need to explain a little bit on what the heck are we actually talking about here.
What do you say we actually do here? Let's just click into the next slide and just like talk through an example what this works. So you can just step through the whole thing. So yeah, I mean, if you look at a field that you own today, oftentimes you have like there's plenty of free and clear land. I mean, and there's all the stats around Iowa, but you know, folks that are in growth mode typically have quite a bit of their ground at least has some cross collateralized note, or there's some debt on it. And that's just fine with Fractal because you've often built up a ton of equity. So like the situation you're talking about, Mitchell, especially with land where it's been in most areas over the last couple of years, you've seen significant growth in equity. And so what we do with Fractal is we look at a piece of farmland that you own today. And we will go and we will buy up to 45% or the rights to up to 45% of that land. And then you will take the proceeds from that sale to go buy another piece of ground or to put on more on-farm infrastructure or equipment, whatever makes the most sense for your operation. We do not tell farmers how to farm. We don't tell them what we're going to do with our money. So you've sold that. Now what happens? Well, on that share, now imagine that you have a contractual relationship that is going to govern everything else. So we agree to a rent or essentially an annual payment rate that is a set percentage of value. Today, it ends up being about 4.5 to 4.7%. And then you get discounts that we'll talk about for regenerative practices or soil health building practices. Then our farmers make money on the appreciation. So this is a 10-year instrument. It's locked in. Farmer or the investor can't tell you, hey, we're going to go sell it at any point within that. And you get to have the rights to farm how you want to farm within those 10 years. You can buy out the investor at any point within those 10 years. And then at that 10-year point, you can either buy us out or you can renew for another term. So at the end of the day, like, yes, there's a bunch of new stuff that's kind of just new about this. It's not that complex, but it's, you kind of, it's almost like you get the advantage of renting in terms of capital efficiency, but you keep control. And then as the farmland value goes up, we both win. As it goes down, we both lose.
So when I first was like hearing about this and just trying to think out loud for clarity for everyone that's on here as well. Okay. Back to, again, the concept of this talk is not to be a sales pitch for Fractal. Although I do see a lot of value for a lot of our customers and people that are on, like, I do think there is probably opportunity here. But when I first was thinking about this, I'm like, gosh, I hadn't even really thought about that built up equity that I've got in my farmland. I mean, there's a couple $100,000 worth of value there that I'm not able to realize. Now, Ben, helping educating me here too, and everybody, why couldn't I just go to the bank and say, hey, can I refinance this piece of land and utilize that built up equity? Or could I kind of do that? And then the value here is just in the rate, right? I would be getting a better rate.
Yeah, I would think of us as a complement to debt, not a competition. So, every farm is different. And so I would urge folks to think about not just where their operations at today or that next deal, but what are the next 2 or 3? And typically, if you just do the math on, hey, if you know that you want to expand by, I'll just use a nice round number, like 25%. Typically, people, if you just do the math on how much money those down payments will be and how much money you normally make in a given year per acre, what it typically means is like you can't pencil it. That's where Fractal comes in. Now, when should you use Fractal versus debt? Like, that is an operation by operation question. And typically what I'd say is you already know kind of what buffer you want to keep in terms of cash and debt service coverage ratios and things like that to make sure that you are not putting your legacy and your family's legacy at risk. So that's a really important number to know. The next one is, well, how much cash do you have on hand on top of that number to invest? And do you want to use that all right now? Or do you want to maybe use some Fractal and some of that to do that deal? So that way you're ready to do the deal after and the deal after and to do it really quickly. So you're not going to hear us like pushing people to say like, do it now, use Fractal now. Like, that doesn't make sense. It has to be right for your operation.
I think penciling that out is really the key thing, and how I've got to, again, I'm thinking out loud here, and hopefully this helps everybody. Just again, with the point of thinking about your expansion opportunities of where your farm needs to go in the future. For a mine, yeah. So say an opportunity comes up where I need to put down a $80,000 down payment. Say there's, I've got $30,000 in cash. I need to come up with another 50,000. The cool thing I believe here, right, with Fractal, that I could say, hey, Ben, I need $50,000 in cash. Can I put that amount of my farm refinanced basically through Fractal, right? So I might have a couple $100,000 in built up equity, but I'm not going to refinance the whole thing. I don't need, say it's $150,000. I don't need 150,000. I just need 50,000, and I can go and get the cash only on that percentage amount that I need.
Yeah, I mean, the thing essentially, like a bank will loan up to what will cash flow on a given field, right? And so really what we're doing is you have strong cash flows from across your operation, and we're taking some of those to cover the annual payment of Fractal. And then so you don't have to sit and wait for 5 years to save up enough money to get to that down payment. So again, we're not a silver bullet. It will help. In terms of your case, like, should you use us versus debt? There's a lot of those cases. You might if you got a great banker who will allow you to take out a second mortgage, maybe that's the right answer. But the big thing to remember is that the payments that you're going to have on debt is going to include both principal and that interest payment, and that ends up being a lot more cash expensive than something like Fractal in the near term. And it's all about that cash management and making sure you have enough cash to go take advantage of that deal that comes across the road that just always happens to happen right after you've bought another piece of ground or other capital investments. And land in Iowa comes up for sale once every about 65 years is the estimate. Like, that's a really tough place to be, and that's the problem we're trying to solve.
Yeah. How fast does it happen? So like, say, I mean, a lot of these deals, they happen really quickly. Like, are you guys able to act fast enough for, like, I know you've been hiring people like crazy, but I mean, some of this stuff, like, you've got, say you're renting a piece of land, they call saying, hey, we're going to sell this thing. If you guys want in, you got till the end of the week.
Yeah, so I mean, this is where my bias of being a former Eagle Scout and a former infantryman kind of shows up. Like, you better be prepared for it well ahead of time. And so what we generally do is we will do a valuation on a field with a farmer. We'll agree on that valuation, and either the farmer will pull out the capital early because they often maybe they'll pay down their operating note, and you're going to save 8-9% on that, and then you just wait until that next deal comes available, or you can just go agree on a valuation and then pull that capital as long as it's available at that same rate, with Fractal at that time. So we do all of the underwriting, everything ahead of it. Think of it as like a pre-qualification on steroids.
Yeah.
Because I don't want to be in between you and your banker. Like, that relationship you have with your banker or bankers is more important to me than, frankly, like our own underwriting in that. Because if I screw with that, like, that's going to be a really tough place for us to be, because we need those bankers to be our allies, and you need them to have a secure source of capital, and I cannot put your operation at risk.
That's right. Interesting. And John you had mentioned it before too, as you're looking at farmland, transition planning and stuff like that. Hopefully, opportunity here to just be thinking about the long term, be thinking ahead. I think as farmers, it's sometimes hard to think that far ahead from a financial perspective. We think about it from maybe a legacy, a soil health, having that next generation to take over the farm, but is it actually going to financially work, and running the numbers and stuff? That piece can be hard. So yeah, no, John and I've been having some conversations that I think probably some opportunity for you guys to chat here too and have some strategic alignment. But okay, so yeah, I mean, opportunity here that can tap into some new capital, but knowing what the options are ahead of time that definitely makes sense. So what else we got? Okay, yeah. So that's what we were briefly talking about this before, but you guys are going to offer farmers discounts here now for implementing a lot of these sustainable ag practices that we preach here at Continuum Ag all day, every day.
Yeah, and at the start of it, and just to be clear, like, what we're selling on this thing. So, like, I always ask, kind of like, what does everyone have behind it? At the end of the day, where a farmer thinks that these practices are good agronomically and from a cash flow standpoint, so do we. Hence why we do not prescribe these practices. Where my family, like where the original family homestead is in central North Dakota, you probably won't ever put a cover crop on, maybe once every 5 or 6 years. Yeah. Very different ball game than Eastern Iowa. Yeah. And we wanted to reflect that, because it's, again, not to be too commonsensical about things. Agronomy is very local, and so should a program like ours. And so what we're doing here is essentially we charge a lower annual payment, ends up being 0.2% of the value of the field per practice that is discounted. And so, if you have a $10,000 field, you're doing 5 practices, that's $100 an acre. That's being reduced. This isn't a carbon program. It's not even a 45Z kind of ethanol program. It's not a climate smart commodity program. This is what we believe, where there's alignment with a self-interested farmer, which all our customers are. We think that just leads to better yield resilience, better cash flows over the life of it, because that'll lead to better asset value. We should share in some of the risk with the farmer, so we give them a discount. And it's your normal basic principles. We're not reinventing the wheel. Cover crops, limited tillage, reduced tillage, reduced disturbance, in-season nitrogen, diverse rotations, vegetated buffers, grass waterways, and then we give some extra credit, if you will, if you've been doing these things continuously, because obviously you see increased soil health benefits there.
That's cool. Yeah, as you as we were preparing for the meeting, it's like, okay, everybody and their dog has a program that's trying to incentivize these practices. And but with this, like, if you're participating in Fractal and you're doing some of these practices, you're going to farm that way, it's just an added bonus. But you guys, I'm assuming you have to see some data, like the farmer's got to verify whatever that these are legit somehow. But other than that, you're not making any claim to them.
Yeah, no claim. And the data collection we typically want to see is like, it's pretty, so I mean, you and I are both familiar with a lot of the remote sensing tools and things like that. We'll use those to make them as kind of hands off as possible. But if you're in any sort of other program, we'll actually just take the evidence from that program for us. Our bar is lower than most of those other ones because we're not making a climate claim. So we don't play by the climate accounting rules. Those programs, there's a lot of value for a lot of folks, not for everyone. Yes, there's some flaws out there. So we're just trying to, again, like, call us really old fashioned and simple, like, where a practice we think will lead to soil health, which will lead to cash flows. Let's incentivize that. And that's kind of but that's it. And I don't care if you're an early adopter or if you're just starting, both of those are valuable.
Yeah. Well, and obviously this is a part where for Continuum and Fractal to continue to have conversations too, our customers, we're documenting pretty well all this stuff right now anyway. So it's a good additional, additional simplifying and
like I haven't seen your end of season report in a while, but like the last one that I saw, like, okay, press print, send that to us.
Done.
Great.
Super easy. But why? So what's driving this? So you mentioned it a little bit, but I want to stress this again and think about this more so from maybe not just a Fractal perspective, but from Silicon Valley, from investors. Why are they saying, hey, let's give customers discounts if they go do these practices? Help to educate us on what you're seeing.
Yeah, I mean, I'd say there's two answers to that. The first is there are some folks that just want to see the ecological benefits of this, and wherever an investor has a discount that they will pass on to a farmer, we'll pass that through. It's not our job to capture that, because that helps us, because it helps our farmer and we're able to grow our business with them. So there is some kind of just like impact kind of aura, if you will, about it. But where I get passionate and where we get really excited about this long term is we want to go out and prove the portfolio level cash flow effect. So like maybe translate that into like non-finance speak. Does it pay? Does us having a portfolio where we incentivize these practices and more of our customers are using these practices than not, will that yield better financial results over the long run? We believe the answer is yes on that. And as we prove that, then, I kind of use the soulless capital test. I want somebody who doesn't care about farmers and doesn't care about impact. Would they look at the cash flows and invest in that? If yes, then heck yes, I want them involved, because what I want is more capital coming into the industry alongside farmers versus competing with them. Like, that is our North Star. Yeah. And if we think that that translates into, kind of an adjusted cost of capital and rewarding farmers for what they do, like, we get really, really excited about that from a rural communities, farm financial health, and long-term environmental impact. We think it's one of those win-win-wins, but it has to have the farmer at the center. Otherwise, we're going to frankly prescribe stupid practices that have a negative long-term environmental and financial impact.
What's interesting to me is, that we started off, talking about institutional land ownership and stuff. And instead of those institutions purchasing land away from farmers, this gives them an alternative that they can still participate in agriculture and ag land, but they can do it. There we go. Sorry. But they can get that financing, but they can keep the farmer at the forefront, and they take a minor stake, not an actual claim to where they're going to come in and seize the land. If the farmer has a bad year or something like that, like, it just I think it puts that farmer in a lot better position that they're in control. They're still in the driver's seat.
We think that's better for an investor too. Like I remember the first time I got challenged on doing these minority investments, and I happened to be in New York, and they're like, well, why are you doing minority investments? You're giving up control. How are you going to have impact or financial returns? And I just kind of sat back and was like, well, what do you think? And I pulled up a field that happens to be a good friend of mine, and I was like, what do you think they should plant here, sir?
Yeah.
And then asked a couple other questions and tried not to be too much of a jerk about it. And they got the point pretty quickly. And you add on lower transaction costs and just self-interest and kind of belief in the power of the individual to make local decisions. And people get it pretty quickly. I think the reason it hasn't existed in the past is it's really hard to do a ton of smaller deals. And there's not a lot of people who know how to work with farmers, who know finance and know how to build the software to enable us to do a lot of these deals pretty quickly at low cost. And so we just got really, really lucky where we happen to have all worked together and have a bunch of people who are really passionate about solving farmer problems.
Yeah, because a lot of your team, like it was buddies that you were already working with at previous jobs. It's and you're out there in Silicon Valley now. You've been out there for
our team is spread across the country. We're a remote first team, and our go-to-market team is firmly in the Midwest. Like Minneapolis is kind of our go-to-market HQ, if you will, or outside of it. So at the end of the day, it's just bring in the right values aligned talent and try to go solve the problem in what we think is a pretty common sense way.
Yeah. Pretty interesting stuff. If people, if you have questions, stuff, definitely jump in. We're going to kind of pivot into some different things, but let's, last couple of kind of items on this, and then maybe we'll pivot and go a couple of different directions here.
Yeah, I mean, I think we've talked about most of this. I mean, really, where we're seeing people use our capital, and just to be clear, like there are other solutions that are out there. Like if you have, we have many of our customers who use us alongside maybe an investor partner they already have. It might be the dentist in town. It might be a high net worth individual that you met in an Iowa State game. It might be, whatever that is.
Smart guy there.
Yeah,
super
if
smart.
You got it, and if you got a great deal, like we want, please take that, bang a deal, like every day. Really for us, this is to fill the need when either your own capital or the normal investor partner you have doesn't fill it, or a more transparent need. And usually it's, hey, there's a big chunk of rented ground that's going to come for sale, and yeah, you'd love to just keep renting it, but you're either going to lose it or you're going to rent it for a heck of a lot higher rent. It makes sense to buy. So that's one big thing we hear a lot. Land deals that are coming from the market, they're bigger and bigger these days, and that's just really hard to pencil with your banker at a given time. We're trying to give you and your banker another tool in the toolkit. And really, at the end of the day, it comes down to, how do you expand and make sure that you have the right asset base to support your operation? Bigger is not always better. Like financial discipline, the right strategy for your operation is the right strategy. Like we're not saying bigger is better, but any type of assets that you need to have tend to be really expensive in ag today. And so that's where folks are typically using our capital.
Interesting. Yeah. And again, that's where like I could see us, more so on like the number 3 kind of side of things. Hey, how do we just tap into built up equity that we've got and make sure that we're in position to access the next land and grow? So I think a lot of farms on here would be resonated with a lot of these items here. So okay, yeah. So I was playing around with this a little bit on your website here too, but I didn't think about it enough before. But really, in order for me to be in preparation to potentially utilize Fractal, I need to kind of understand how much money would I potentially be able to tap into. So it is a little bit of a proactive approach that needs to be taken.
I mean, most folks that we're working with who like see the value in what we're doing, like they're going to go out and they're going to get a valuation with us. That allows them to get under the hood, get into the spreadsheet, really understand what this is all about. And so that way they're ready to pull that trigger when that need comes. And I can't tell you how many times folks have been like, oh yeah, this is interesting, I'm just really busy right now. And then 3 weeks later, like, oh, hey, I have a deal. And, for us, just to be really transparent, like we have a lot of farmer demand right now. And we go first come, first serve, or somebody that we've already worked with, they can kind of jump to the top of the queue. And that's just because, at the end of the day, like we have to deliver on our word. And that means that, the people who came to us, like we need to be responsive there. And anyone who we've done work with, they'll move to the top of the queue for their next deal. So we just try to be really, really honest and upfront about, what the process is, when we're ready to give you capital and how much. So that way, when to either rely on us or when we're a maybe or when we're a sure, because we can't let somebody down if they're relying on us to have capital. And that means we have to be a little bit pushy about, hey, are you in the rely bucket or are you in the maybe? And if you're in a rely bucket, you got to take it.
Yeah. No, makes sense. So you're kind of wanting to maybe pivot a little bit here. The what you were just kind of hitting on is, I think, something that's really important and what I was just thinking about that we should pivot to, which is the relationships and under promising and over delivering, or at a minimum delivering on what you say that you're gonna do. Um, Before we started here, we were starting to talk just a little bit about other agricultural technology companies who have very deep investor pockets behind them, who oftentimes go to the ag space with the Silicon Valley mindset of disruption. And they think that that is disrupt everything, disrupt technology, disrupt relationships, go in there, and they're just going to be the only ag company left. And all the other players are going to be working for them. Someday they're going to buy them or they're going to be out of business. And a couple of these companies have been in the news here recently that they're not doing well at all. And obviously, Ben, as you being a Midwest guy, but living in, living in Silicon Valley, how do you see that approach, or what's your thoughts? I guess as I'm talking about that Silicon Valley approach of disruption versus how you mentioned it, which is no, actually relationships are what's important, and I think that's on display with those examples in the headlines.
Yeah, I mean, I think the reality is like there's a lot of great tools, there's a lot of great talent out here, but like even folks out here, you have them spend a couple weeks back home and like at like with farmers and like they get it pretty darn quickly. There's a lot of things about our current system that could be improved that are tough for farmers. I'm not saying things are perfect, but like things are how they are for a lot of good reasons. And I just think there needs to be a humility to ask why things are how they are before you think you're going to break all of them. And so for us, we have a couple of very simple principles. One is you don't win with a short-term game in agriculture. Like you need to be thinking long-term. And if that means that, when we're having a conversation, like we could push somebody and get a sale today, or it's the right answer for it to be in a month or a year, we should always take the month or the year.
Yeah.
And like, I know that sounds really, really simple, but like simple doesn't mean easy. And I can understand why folks have made other decisions. That's just not what we're going to do.
Yeah.
I think the second is like, we're not trying to be everything to everyone. Like we're not the star of the show. It's the farmer and the farmer advisor. We're capital providers. We're a tool, and hopefully we'll be the best darn partner and best darn tool that you've ever worked with of this type. But at the end of the day, like we have several great partners in the field. Like I will be in Des Moines here later this week with a great partner we have on the cooperative side, and like they are the stars of the show along with their owner members. At the end of the day, we're just helping them with that tool. So we don't need to go disrupt and be everything to everyone. Our job is to go get capital at the lowest cost, and we think there's a great business to be run there, and just take advantage of some common sense assumptions about just farmers as the best managers of the asset, and then price in cash flows and soil quality.
Yeah. No, I think that's spot on. And again, that's a couple of these big players, Indigo and FBN, that have approached the ag tech space is like we're going to come in and just disrupt everything, and they've raised a whole pile of venture capital, and especially now Indigo, like we don't know exactly what this situation is, but like it was a lot of over promising and under delivering, and it just leaves a bad taste in people's mouth, I think, and farmers see through over promising and under delivering, and the word spreads very quickly. And yeah, you might be able to get people signed up in the short term, but in the long term, those deals go away, those farmers leave, and you don't get them back. So I think that approach is correct, and it's something that we continue to try to really strive for at Continuum as well. Is how do we bring disruptive technology to strengthen the existing relationships, because that is absolutely the most important thing in ag. But a lot of groups aren't fully getting that figured out like you guys are.
Yeah, I mean, I'd say the industry's learning, right? And that's really positive from venture capitalists on down. Like they're recognizing that. I think, you look at Indigo, they've made some great partnerships that have been out there before. And there's a lot more humility from a lot of great people at these companies. Just like, honestly, I think there's a lot of great people at these farmland investment companies. We're all just kind of constrained to our incentives and everything else. And so, again, like we have to keep a lot of humility. We're not going to do everything right. And so it's about being able to listen and have enough customers who have your phone number, who will tell you the truth and tell you off. And I've already had that a couple times, and I'm very thankful for that.
Well, but it's being able to listen and give feedback. And you got your early stage. I mean, shoot, when did you guys actually launch this? It's only been a couple months.
Yeah, I mean, we had our public launch last week because we wanted to actually get a bunch of deals done, get the kinks out before we had a much PR. Yeah, just our
So
approach.
public launch last week at Farm Progress, right? You guys were out there and did it at Farm Progress.
Correct. Yeah. I mean, before we wanted any media, we wanted to actually do some deals. We just thought it was really important to work out the kinks and kind of do the right thing before we're talking about ourselves. And at the end of the day, again, it's not about us, it's about our customers and about their advisors.
That's super cool. Along these lines, a plug for our webinar here in 2 weeks is with one of my core and earliest business advisors, Dave Stamp. Long career in the ag space, and Dave is coming on. We're going to talk a lot about these relationships, about how do you build a company the right way in agriculture. So just a little plug there for our webinar coming up in 2 weeks. There, watch for our emails coming out about our social media or on our website. There's information about our upcoming events and stuff there. But okay, so let's pivot again here, Ben. Anybody, of course, if you have questions or want to come in and ask a question live, just raise the hand, use the raise the hand function, or type in the chat. Definitely want to get your questions answered. But I want to pivot a little bit here, Ben, because when you and I first met, it was all the talk was about carbon. And that was going to be how we were all going to go make money in this space, and farmers are going to, make money being carbon farmers. And don't think anybody's necessarily really gotten rich off of carbon programs. Kelly Garrett has done pretty good, but other than that, nobody's really made much more money off of it. But my buddy Kelly has done well. But things are shifting though with this carbon intensity stuff and that scope 3 angle. And just speaking more so now about your history with in the carbon space, where you were with Corteva and you just know a ton about this, but can you maybe explain from your perspective, like what are we going through here in the carbon world, like the shift that's occurring?
Yeah, I mean, at the end of the day, it's like, where are the end dollars at the end of the rainbow, and how does that come back? And so, I think everyone got really excited about carbon offsets, but we didn't really know what it would take to get them and what the final price point would be. And honestly, for a sliver of customers, carbon offsets are probably still the best deal that are out there, and that just excludes a lot of folks that we need to include. My own family were early adopters in North Central North Dakota, and it was some interesting Thanksgivings about that. So, I mean, clearly there was a gap. I think everybody at those programs would say there's a gap. Yeah. But they were actually paying farmers, at least, where I think before in a lot of the CPG programs, they were, hey, give us all this data. We're going to make a claim, but we're not going to pay you for it. And that was frankly BS. I have stronger language I won't use when we're recorded about how I really felt about that. And I thought that was really important to push those scope 3 and CPG players out now. And there are some great early brands that have been willing to pay. You look at General Mills, Pepsi, Nestle, amongst many others. Like, there's just some really good stuff there that's happening. But at the end of the day, that's still kind of consumer and company ESG pressure. How long is that going to last, and at what price point? Which is why I think we both independently, and then realized we were both thinking about the same thing as I was kind of leaving Corteva, where some of the biofuels quantification was really exciting, because there are large pockets of money, both governmental and private, out there around that. And so at the end of the day, I don't know what it's going to look like. I just think that you have to find an area where you think you can position yourself to take advantage of the most profitable opportunity, not kind of lock yourself out of future opportunities, but take advantage of the opportunity in front of your face. And so what would I do? I mean, it's make sure I have the data, make sure I'm doing the practices for agronomy. And if I knew that I was going to get a payment that was 20, 50, or $100 an acre, like depending on where it's at, I know what practices for those payments I would implement, because I think they're close to break even. They're just not good enough right now. That's how I'd be approaching it. But I'm not a farmer, so I'm not going to tell a farmer how to farm. Like, there's a lot of complexity in a lot of these practices. So it just kind of comes down to,
but it's weighing out the return on investment from it. And I think that's what's really crucial. And I do think that's what has been really screwed up within the carbon offset space, is I've still never seen anybody put together, what does it cost to create a carbon offset?
It is not cheap at a small scale. It gets a lot cheaper at a large scale, which
It's
is why
but still, like,
I'm more bullish on the larger players. And like, I obviously came from Corteva. Like, we partnered with Indigo because we thought they had the best offset science and market, and I still believe that on the offset side. I just think there's a lot of other opportunities that they and a lot of others are involved in. And at the end of the day, like, like they're all a real big pain. And so if you're not working with somebody to help make that digital experience easier and tied into my agronomy, it's tough. And some folks know how to do that. I wouldn't know how, and a lot of my friends and colleagues don't. And so we just tried to find the right organizations that knew how to partner with the farmer.
Same thing. I mean, me too. I mean, Continuum Ag, we've been working with a variety of carbon offset project developers. We are not a project developer, and same thing. Like, we don't want to be. And I was on the working group with Climate Action Reserve that wrote that protocol that Indigo used to create their initial offsets. Like, I was there when the protocol was written, and still I don't want to attempt to go down that route of developing carbon offsets to participate in those programs. The shift has been, with, okay, instead of selling a carbon offset credit, what's happening within biofuels and these 45Z things. And again, in the spirit of, talking about farm finance and how do we get creative to put dollars back in your pocket, for me, I think this is where our big opportunity is gonna be, which is the 45Z tax credits, low carbon biofuels. And hopefully a lot of you have seen this. We've got multiple other webinars and materials on our YouTube page where we dig really deep into this. But essentially, the graph on the right-hand side is the important one here, which shows as a farmer reduces their carbon intensity score, which is the axis along the bottom, as they reduce their carbon intensity score, they create value to the tune of the numbers on the left-hand side per bushel. Now, what is still yet to be known is what is the farmer's cut going to be? Because this is the total. Okay, so this is the total value of these credits. But I think, Ben, the opportunity for lowering the carbon footprint of the bushel and having the data and the carbon or the other environmental outcome, have that data stay with the bushel or with the gallon or the pound of meat or whatever. That data stays with that product and goes into the supply chain. I just think that concept is the right thing, of that data connectivity, transparency, that scope 3 reduction story. I just think it's going to make more sense for agriculture at scale.
Yeah, I mean, I hate policy. I just am a impatient person and spent time in the military. So like the policy and government landscape just scares me, even though there's a lot of amazing people who try to do great work there. And some less than amazing things that also happen. At the end of the day, you have to be prepared for success on this thing. And so I think it comes down again to every operation. If you're already collecting a lot of this data, or if you have an advisor who's already helping you collect this data, you have more options. And this is clearly the area that has probably the biggest dollars and cents potential in the near to medium term. And so this is another reason, where we selfishly love to invest in folks that are doing these things, because they are going to have a lower CI, which means they have better cash flows. And that means that the land value will be higher. So we're all for it. There's a lot to be sorted out. And I think that's why working with somebody who understands that landscape, so you still need to, but they can help accelerate your own learning as an operator, is a really, really important kind of path forward.
Yeah, I think that's the right thing. How we've been approaching is, farmer, hey, let's figure out what your score is today, and let's identify opportunities to lower that score, and let's keep you in control of your data and in control of your own destiny to tap into these opportunities if they do present themselves and are deemed to be the most profitable, opportunity for you. I believe that they will be. On our farm, we've got some of our fields have CI scores of negative 10.1. I mean, that's more than a $2 per bushel type of opportunity to tap into. On 240 bushel corn, you're talking some real dollars per acre. And now, again, I don't know what our cut of that 500 some dollars of economic value is going to be, and there's a lot of cost to it. There's a lot of moving parts, but it's just a more enticing pie, and that's why we're at least spending some time and some brain power to focus on. It's a big enough opportunity. Let's at least be in position to capitalize on it if it does come to fruition. Something to kind of talk through out loud with you here on this. What is the amortization? 10 years? Was that, Ben, I think that's on your stuff. There's I believe the question in the chat is, what's the amortization? Is it 10 years? What's the estimated interest rate? I believe talking about Ben's stuff. Clarify if we're wrong. In the tax credit stuff that I've got on the slide here, you get paid a premium per bushel. So it's what was the carbon footprint of that crop year and of that bushel. And when you sell the bushel, you sell the bushel at the price of the bushel, and you sell the data. And that's where topsoil comes in. You sell the data and you get paid your percentage of the tax credit premium for the data. You get paid at that time of sale, or very soon after if it has to go through some kind of an audit process. But Ben, I think the question being more so to you had mentioned a 10-year payback program, right?
Yep. And so generally, like the payment itself is just a percentage of the value of the Fractal share. There is no actually amortization. You can buy us out essentially all at once or chunk it out as you want to. And then the rate, like I mentioned today, roughly 4.7% of our share. So you'll typically find us, we will track kind of as interest rates rise, we will likely increase to some extent too. But we'll essentially always be below interest rates on where that fits. Otherwise, we wouldn't really be solving the core problem.
So if my farmland is worth $10,000 and I finance $2,000 per acre of that value with you guys, I would owe $2,000 per acre over a 10-year period, but
Yep.
my payment would be 4.7% of the 2,000.
Correct. And your payment would probably be a heck of a lot less than 4.7% because of those
Because of the
regenerative.
stackable practice. I'd get the discount and stuff on that. Yeah.
I mean, we just closed a deal or with some folks in central Iowa, and I think they were paying like 3.8%
Yeah.
on it.
But it's 3.8% interest on top of. So if I borrow 2,000, quote unquote borrow, I don't know. I'm still learning to figure out what is the right terminology.
It's not debt. So it's, yeah, if we invest $2,000 in that operation, it would just be that 4.5% or that 3.9% on the $2,000
on top. Yeah. So I've got so if it was no interest, it'd be a $200 per year payment because the $2,000 that I got invested divided by 10. So it's $200 plus the 4% or whatever your actual percentage ends up being on top of that.
Correct.
Yeah. So so cheaper than going and trying to finance it somewhere else. But for some percent, like it's not anything crazy. Like you might be able to find some cheaper capital through certain programs, but a lot of interest rates today are a heck of a lot higher than 4% and they don't reward you for implementing good regenerative practices either.
Yeah, I mean, the area where we are more expensive is like on that payback. Like you will have to pay back the appreciation on it too. Now, where it really fits is that if you're selling us a portion of land and then you're taking that to buy another one, really that appreciation, you're actually going to see it back over here and you have more total equity in the system that appreciates. Same thing if the land depreciates, then you don't have to pay us back as much. So there's kind of when you win, we win, when you lose, we lose. And trying to create that symmetry is a really, really important thing in our mind. Otherwise, we can't have aligned incentives.
Okay, going back to my other topic that I wanted to bring up here. Was on a meeting here the other day. I want your kind of thoughts and hot take on this. I was on a meeting the other day with a company that was looking at should we develop a insurance program for revenue protection around carbon intensity. So if I'm going to create, say I think that my carbon intensity is going to be worth $100 per acre, I could insure that with the company and get a revenue protection, just like crop insurance. Say it's 80% revenue guarantee or 75% or whatever my guarantee is going to be, just like in crop insurance and overall crop insurance. So say I have, for easy math, say I have $1,000 per acre in my annual revenue, that I'm securing, and I'm buying crop insurance to have revenue protection at a 85% coverage rate. Opportunity here to do the same thing for carbon. My carbon intensity is going to be worth $100. I could buy insurance that, say the carbon program goes away or the value of the carbon changes, or more so how I was thinking about it is that farm in North Dakota. Hey, I'm going to try my best to get a cover crop out there and get it applied. But if, it freaking snows in North Dakota, I don't know if I'm going to be able to get the whole plan implemented correctly. Can I purchase some type of a insurance program to at least cover a portion of that potential revenue to help to cover the cost of implementing that practice? and to lower the risk of implementing the practice. But have you heard anyone kind of looking at some of this stuff, or what's your hot take?
I mean, that I haven't heard that angle. I've heard, and I know there are some folks that have been working on kind of like further subsidies for crop insurance that are essentially based off of the practices that are being used in the overall kind of risk from the yield resilience benefits of it. But yeah, I think we're on some of those even more creative products. Like I do think at the end of the day, as we prove the financial case on a field by field basis of these practices, there'll be a ton more financial products that'll come out.
Yeah.
And I get really excited about that because then you'll see an alignment between what makes sense agronomically and what oftentimes a farmer knows intuitively and what the end product is. And like that's just an alignment that I think matters a lot.
I think so. I think so. This insurance deal, I hadn't thought about it at all either until I was hit up by a company that's like, hey, we like do this. They're freaking massive, like massive company. And they're like, hey, this is like our game. And we think there might be something here. Should we go do it? And as I was thinking through it, I'm like, okay, this would really encourage now a farmer to go after some of these practices, knowing that that potential revenue is protected. If the program falls apart, the policy, especially with this, that's based on policy, like there's some risk to that. So I do think there could be some opportunity to make sure that's protected. But also just think about it from the buyer side of things. If a company, a grain off taker, is anticipating having revenue off of a low carbon intensity product, they could also insure against the value and be able to have dollars at their side that they could still invest in purchasing low carbon intensity grain. Because there's a disconnect there that if they're buying low carbon intensity grain in 2024, they don't actually earn the tax credits until 2026 or realize the tax credits until 26. So having a insurance program to cover the revenue on that, I think could be really, really interesting. But
there's a reason I escaped a lot of the complexity of that space. At the end of the day, like I like we're good science and farmer intuition align incentives say, hey, go do a great practice there. That's where I'm all about. I think it's a good use case. Everything else that relies on a lot of those government and kind of other incentives. And I think there's just a lot of differences in that yeah, trying to stay away from right now. Keep it simple, stupid.
I appreciate your cop out there. Thanks, bud.
Oh, 100%. 100%.
No, I love it. But it is something really interesting. I think the point there being, hey, as agriculture and especially regenerative ag is obviously becoming sexier and sexier in the company, in corporate eyes and investor eyes, there is more opportunity there for innovation and for new initiatives and stuff. And we want to just continue to bring those opportunities to the forefront, make people aware. And that was really the intent of this is, hey, this is something that I'm personally looking at. And I think, things that I'm watching, things that I'm chasing, I want to make sure everyone else is aware as well. But Ben, I know was it fractal.ag? Is that you guys' website for the kind of, because really the next step of what I need to do is I need to fill out the initial onboarding analysis, right? To identify, okay, what is my opportunity? Yeah, there you go in the chat for everyone.
Yeah, I mean, it's compared to any other programs you've been in, it does not take a lot of time. What we need is like a field boundary, what your like very recent cropping history looks like, essentially what some of the management practices have been, and then just some other like really, really basic info. Typically we'll connect to your My John Deere, just get that agronomic info on it. So that way you can get paid for your agronomic performance, and especially if it's over performance. But really the total data requirements shouldn't take more than 15, 30 minutes total at the end of the day to get evaluation.
Cool. Yeah, and again, that's something for everyone that we'll definitely do some pushing forward to see, hey, could we make it even easier for topsoil users that we've already got? If it's historical management data, yield info, management, input management info, so we've got that within topsoil and the boundaries too for most of those fields. So maybe it's something that we can help to facilitate. If you do want help, exploring Fractal, definitely hit up your Continuum Ag representative. They'll definitely help you out and getting that info and putting that stuff together. But anyway, no, Ben, this has been fun. And I think, just again, good for people to be thinking outside the box, get creative. There's opportunities to grow. And I think we're going to have to. There's going to be less of us family farmers that are able to manage the land, and we're going to have to grow and we're going to have to be able to manage more acres. So I know for me, it's going to take capital to do it, and we've got to be in a position to take the opportunity when it arises. So any party thoughts here, Ben? This has been fun for me. Hopefully everyone thought it was good. So, and again, we'll get this up on our YouTube page for folks that had to drop early or folks that couldn't make it today.
Yeah, I mean, I think just the biggest thing is like if the need that we talked about is one that you feel, you can just click on online fractal.ag, and we'll reach out usually within 24 hours, get you evaluation, see if help you understand if this is the right fit. And you're not going to get a hard sell. It has to be the right fit for us to want to do a deal. And at the end of the day, it's just trying to keep farmers kind of at the center of our agricultural system. And we think that's just a very common sense but good business model.
Love it. Love it. Well, everyone, thank you for joining us here today. I just did a double check and looked. Our next webinar is actually next week. It's September 12th. I'm going to be in Brazil 2 weeks from now on the 19th. So don't necessarily want to try to do a webinar from down there. So, but September 12th, 1:00 p.m. Central Time, we're going to be talking about relationships in ag and more ag tech innovations. Ben, appreciate you hanging out. Good to see you, bud, and appreciate the time. We'll be in touch here again soon. Thanks everyone for hopping on and joining us here today.